Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan, and it is a delight to be back with you again today. Always appreciate you joining us. Today, we are going to talk about the wealth elevator, and we're going to take a ride on that elevator with Lane Kawaoka. And I am delighted to have Lane back with us. He has been on our show twice before, over about 3 years ago when we were broadcasting under our other label, Creekside Chats with Real Estate Investors, and about 2 years ago on one of the early guests on Real Estate Investing Abundance. And so Lane is a renowned real estate maven with a track record spanning over a decade, steering a remarkable portfolio of over 10,000 plus units. He stands at the helm of the Wealth Elevator. As a licensed professional civil and industrial engineer, Lane's expertise extends to orchestrating capital construction projects surpassing over $250 million in both public and private domains. So welcome back, Lane. So glad to have you with us once again. Tell us about what is a wealth elevator?
Yeah, so my kind of story is I graduated college engineering school, and I started to invest in little rental properties, eventually buying 11 of those turnkey rentals. And then, when I became more of an accredited investor, started investing in private placements and syndications and started to unpack all these other more advanced tax strategies. And this took a long time for me to go. I graduated back in 2007 from college. 2009 was when I bought my first rental property. And then fast forward, well over a decade today. And what I realized was there were certain steps along the way of this wealth building journey to financial freedom, we all call. And there was what I also realized is like things changed along the way, right? From the first half, I kind of started out, with good financial skills, being brought up in a family where, we were good, conscientious with our money, didn't spend more than we made. And then that first half was buying rental properties, but then obviously it kind of pivoted after a certain point. And there's been a lot of financial books out there, none that I think focused on more your higher net worth type of investor, the people making six figures, multiple six figures a year, and certainly had $1 million net worth or greater. And what I kind of created within the wealth elevator analogy was there's different floors to wealth building. If you're in the basement floor, you're starting out, you're trying to get a budget, right? Like I think this is what we all want for our kids to kind of learn and emulate. But at some point, it's more about, and this, I think people know this as like the Kiyosaki mindset, moving from the Dave Ramsey to the Kiyosaki mindset, which is, using good debt and leverage. But I would say when your net worth goes around $500,000, $1 million, you kind of go on that second floor of the wealth elevator and you start to invest in more scalable types of commercial assets and different tax strategies and infinite banking at that point. We've actually got like in the book, a nice little chart, because I think a lot of our readers and investors are engineers. They like that type of stuff, but different strategies within different, what do you do for investing? What do you do for, are you even doing a 401k retirement account or a Roth? And then what are you doing for taxes and infinite banking? And then, what are you doing to protect your, assets legally?
Well, take us into that. That's a nice, big, broad overview. Let's get into the nitty gritty a little bit here. You gave us kind of a concept here. You started off with single family investing, which a lot of people do, and you developed a basic level there, and then you went to a different level of investing once you had reached that first plateau there. So take us into this and give us some details here on that process that you went through.
Yeah. So I guess let's go back to around 2009, 2010 when I bought that first rental property. I was buying it with, really no tricks or games, just 20% down payment. Some of the early ones was with owner financing in a little bit better terms, but you've got to scale from there because each property you buy may be a few $100s of positive cash flow after all expenses. Some of the bigger ones may get you more, but you got to buy more properties, right? And this is kind of where, I had bought like a few units in Seattle, Washington at the time, started to learn about, the difference between primary markets and secondary markets where primary markets were, great places to live, like Seattle, California, Hawaii, New York, Boston, but the numbers just don't work there due to just so much competition. And, this is where I started to discover secondary markets and where you can hit a rent to value ratio of 1% or better to be able to cash flow. And this is kind of where I think there's maybe not a mistake, but like a mindset shift I had where very early on I wanted cash flow. And the reason behind that was I was working my engineering job and I needed cash flow to replace my W-2 income so I could leave said job. So what I realized later as I became more of an accredited investor is cash flow is nice, but what's really important is net worth growth at the end of the day. At that point, I left my day job, right? So that need and that pain point was gone. So, but again, it's all part of the things you learn on the journey, right? Like I think for a lot of new investors still working their day jobs, they may or may not like it. They may not like the people they work for or the work, but hey, you're getting compensated with six-figure plus salary. And some people call this the golden handcuffs, right? You have to go to work. But there's don't get nearsighted on, just going into deals for the cash flow portion. In some cases, they may not be the safest types of deals. And certainly, a lot of times when you pick investments, like for example, a development deal, you may be able to double your money in a few years, but there's certainly not going to be any cash flow because you haven't built the damn thing yet, right?
Right.
Whereas a, semi-stabilized apartment building, yeah, sure, you have some cash flow coming in every quarter on some distribution checks here or there. Or if you own rental properties, you get that monthly checks there. But there is no business plan in a lot of these, right? You're not value adding the asset. And, it's kind of in the short term, you're getting these checks. But when you really add it up, and I think this is kind of where I got to in 2015 when I had 11 of these rental properties. And I was looking to divest of them because I had met a lot of other accredited investors who were investing in private placements and syndications who were dumping their rentals too. So that was kind of a big hint for myself. But, all right, I'm going to sell these properties, right? There's a lot of good online brokers out there that, low fees to sell it. But I'm like, wait a minute, like, I had the cash flow, but, I had a little bit of appreciation. But at the end of the day, I got like 10%, right? Like that's pretty lame for all that kind of effort. And, you got legal liability when you're a landlord, which you don't have when you're a passive investor in syndications. But for me, what really tipped the scales was, again, going back to 2015, I had 11 rental properties. I had for people who own that many rentals, things go wrong. And I had professional property management on them. I'm working my engineering job and I'm busy and I don't have time to deal with this stuff. And I'm having maybe an eviction or two every year, which is pretty typical. And these guys would trash the property once in a while. And I got stuck with like a 10,000, once even a $20,000 bill. I actually on my YouTube channel, I have like a walkthrough of like the house and it was just trash, right? Like dog poop, everything you can think of. And this is kind of where I was like, well, what was the point of all this, right? I thought we were trying to make money, and that was kind of where I transitioned to, syndications and private placements. But, I think some people will be like, yeah, these bigger deals are better, and they kind of are. But based on where your net worth is, you may not be ready to make that jump quite yet because you don't have the network to be able to source good deals, and you're just finding, people on the internet who are kind of just newer operators. But yeah, going back, like the cash flow is very important. And this is kind of what I've learned and emulated from other higher net worth investors that I that I talk about in the book and things that I've experienced myself. And again, that's the transformation from, I want it now. I want cash flow every month or every quarter. That's not how high net worth people think. They think more in longer time horizons. They're willing to delay gratify. They don't need cash flow to put food on the table or put food for the annual basis. They have other investments, or like a lot of our investors today, they're working their day jobs, right? They may transition to easier roles where they don't need to get paid top dollar at a high stress position because they're investing, saving a lot of taxes, but they're not going to quit their day job anytime soon. So they can provide for their cash flow needs today and let the rest ride and parlay into investments for even sweeter future.
So you say there are 5 floors to the wealth elevator. Take us through each one of the floors.
Yeah, so real quickly, we kind of talked about the first couple. The basement is, hey, get your budget together, get positive cash flow in terms of your budget. A lot of people out there, I'd say most people out there just are really bad savers. And I think this is where buying a house to live in makes a lot of sense for those people because it becomes a forced piggy bank. But I mean, I'm speaking to the people listening to financial podcasts here, right? Or, people who listen to our podcasts. More than likely, it's a self-selecting group. You're probably pretty decent with the basic financial skills, and you're probably on the higher levels, the first floor being a non-accredited investor. And that's where I was back in 2009, 2012, where you just got to buy rental properties. And unfortunately, it's like watching grass grow. You haven't hit that hockey stick quite yet until maybe you're getting into that second or third floor. That second floor is now, you're on the verge or you're already an accredited investor and you invest in syndications and private placements in a much more protected position, where the debt doesn't get put in your personal name as an LP partner. At that point, that second floor is, I think, where most of our clients are at today. And again, it takes a while, right? This isn't the get rich quick scheme. It takes a while to get to where you want to be, which is higher than that second floor, which is the third floor, which in some cases, we also call this the rooftop, the penthouse, because it's ultimately comes down to what your personal needs are. And I define this term end game, and it's different for people, but just to give people a general idea, it's essentially that magic number with some padding in there that you need every month to live a really comfortable lifestyle. For most of our clients that might live in California with a few kids, maybe that number is $4 to $5 million to be able to extract $15,000 to $20,000 of passive income to live off of every month. Now, at that point, you don't need to invest as heavily anymore. And this is what we want to really try and expedite people to get to as soon as possible. And at that point, maybe take the foot off of alternative investments to some extent. But make no mistake, if your net worth is under $3-4 million, you're still in growth mode. Unless, of course, you're retired, your kids are gone and financially, maybe not independent, but financially responsible themselves with their day jobs, right? There are no more financial liabilities to you. You may be okay with, a couple million at that point, and kind of talking about like a range here, right? And it comes down to your personal finances too. But this is where, again, for people under a few $1 million net worth, you're in the growth mode. And at least speaking from my experience, unless you go over 30, 40, 50, 60% alternative investments, I know big range there, you're not going to get the better returns, and you're not going to get the deductions that you can play all these more alternative tax strategies to be able to grow your net worth. I mean, just think of it logically, right? If you normally save 100 grand a year, which most of our clients do, that's great. But what if you can cut your tax bill in half and now you're saving maybe $200,000 a year? Your net worth is just going to exponentially grow a lot quicker. So, and then also, add in there's an infinite banking strategies, banking on yourself, which I think is very common. We have an e-course on that, but the quick and dirty thing on that is just make sure your agent doesn't ratchet up the fees on you. We kind of recommend doing like a 90-10 split where only 10% of your policy is insurance because that's where the fees come from. You want to maximize the amount of the 90%, which is the paid up additions. But these are the strategies that start to get put in place at that point of the wealth building journey. For example, infinite banking, nobody under $1 million should be doing that stuff, in my opinion. You got to be investing, invest in rental properties, come back when your net worth is $1 million or greater. But that's where the next, and this is where like the penthouse is fine for most people. It's go live your life, right? This is more where you become attuned to quality of life. What are you on this earth for? Most people listen to these financial podcasts, myself included, where some would say unhealthily attuned to building our net worth. It's just a number, and we lose sight of enjoying things. I had a great book by Bill Perkins. I had him on my podcast the last year, but Die with Zero. This concept of you have money, and it's definitely predicated to more of the higher net worth people out there. But life is a pursuit of getting money, but exchanging money for experiences. Because after the end of the day, what was it all for anyway? And then, so for some people who would like to continue on to 8 figures and above, I don't know why you would want to, but if you had some kind of philanthropic goal that you wanted to achieve and power, that's where that comes into play. But what we do is we provide kind of a community of people kind of all singing, going in the same direction, kind of saying the same language. And one of my big MOs is get to your end game number, get to that point as safely and quickly as possible, but then relax, put it into cruise control, and then also bring it in the next generation, right? We have a lot of families, myself included, and I always theorize that you got a net worth of 3.5 million, 4 million, and you've got a couple of kids, so you're going to give them a couple $1 million each. To give them any more would probably be a disservice to them. They probably get into drugs or just lose their minds. Actually, they may be fine, but it's the third generation after them is the one that you really have to worry about. So after a certain point, the strategies become more, you've kind of learned it all, young Padawan. Now you need to interact with other people, and it's your network is your net worth at that point to more infuse the teachings, the financial education to the next generation. But personally, I never listened to a thing my parents said, which I got lucky because they invested in 401ks, mutual funds, all the traditional investments. So at least the way I see the world based off my experiences, if there was a rich uncle that told me what to do and guided me, or it doesn't even need to be that formal, but if I could meet some other 30 or 40-year-olds or even 20-year-olds that were kind of in the same wealth elevator sphere, that would have been very helpful for me, and which I think very helpful for younger people today.
Yeah. So after the third floor, what's actually the fourth and the fifth floor?
Fourth or fifth floor, I mean, it's all about, like I said, getting to 8 figures and above, but you don't need to do that. Like I said, I'm more about, it's not getting to a destination, it's the journey at that point. And I think this is where I differ from a lot of people. I'm not a very woo-woo person, if you can get a sense. It's a journey. Yes, it is. But get your butt up to the second floor, and then let's talk about quality of life and having a good time is kind of my spin on it.
Mm-hmm. Okay. Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Going into this further, so what you're saying is that what this really appeals to are people who have successfully navigated the second floor and they're on the third floor and wanting to go to kind of really perpetuate this lifestyle at this third floor level to the rooftop, the penthouse level there.
Exactly. Yeah, mostly accredited investors who want to kind of refine. We have, that penthouse level and the rooftop level, that third, fourth floor that we were kind of talking about. we do have an entire chapter of, pretty much,
Hmm.
football playbook of all these kinds of smaller strategies to kind of implement. But I think most people who are on that stage already, they got there for a reason, right? Like
Hmm.
I haven't seen many people who don't invest in alternative investments and use these similar tax strategies get past $2 to $3 million
Hmm.
before the age of 50, unless they're implementing this stuff to some extent.
Well, exactly. I mean, because without implementing these tax strategies, you are going to have an anchor on your financial wealth development. So you have to implement tax strategies to really get over that hump. At least most of us do. So
Yeah, unless you're independently wealthy, right? And good for
exactly,
you.
or unless you just happen to be in on the tech startup stuff at just the right time, and you can sell a company for millions of dollars. That doesn't happen very often, but occasionally it has happened. But I suppose, but even those people, if they hadn't developed tax strategies, they would lose a lot of that wealth in the transfer of those companies through taxes. So those things need to be in place very early on. So in step number 3, you're talking about various different kinds of strategies. Cash flow is not important, but you still want to continue to develop or at least preserve that net worth. So, what are some of the strategies that you actually are educating people to put in place besides infinite banking?
Yeah, I mean, I guess for like we'll start on taxes, right? I mean, infinite banking is great, but I think it's a very small fraction of impact compared to taxes. One of the big things that the real estate unlocks is you're getting all these passive activity losses through the depreciation of the asset. Now, the cool thing about syndicated deals that are large enough to do a cost segregation or do a more aggressive depreciation of the asset without a cost segregation too, is this ability to extract way more losses in the beginning of the investment. When I owned a little rental property, I think most rental property owners know you can deduct 1/27th the value of the building over 27 long years, which is great. I mean, don't get me wrong, it was great, but oftentimes with the current bonus depreciation laws, I've been seeing like 1/3 of the building value taken in that first year. So that's like a 10xer right there. So it creates a huge surplus in amount of passive losses that you get, more than offsetting the losses, the gains that you get from that particular project, especially in the beginning stages, but as it's getting ramped up. But if you're able to pool these passive losses and offset other passive income, now we're cooking, right? And it's always surprising that these CPAs just don't feel comfortable with that. And they don't understand that. And I get it. That's why they're working their day job as a CPA. They just don't understand these strategies. And that's where, if people need a referral, they can just reach out. We've always kind of been searching for these practitioner of these strategies who are confident in doing this. And quite frankly, a lot of CPAs out there just don't want the headache. They got a good client list. Why rock the boat is the way they see it. Unfortunately, the CPAs doing it the easy way for them is not good and advantageous for you, the investor. Taking this a step beyond, as I just, reviewing what I just said, using passive activity losses to offset passive income is, that's basics, right? I mean, but now what a lot of people have is a high W-2 or 1099 income, which is ordinary income, which is in a different bucket. You can't use passive activity losses to offset that. Now, unless you have a checkbox marked on your taxes of real estate professional status. Now, we're not going to get into like the things there, but basically, if you're able to, rack up 750 hours of active participation in your portfolio, and you don't have a full-time day job, or your spouse doesn't have a full-time day job, this can be a great strategy to possibly lowering your AGI, your adjusted gross income, down to zero if you so choose. And this is a great strategy for, and actually it's very common where you have one income earner making the vast majority of the income, and the other spouse can stay at home with the kids. And you net more at the end of the day because you're implementing rep status, real estate professional status strategy. And this is a good thing. This is a cool thing, right? Like this is like complete game changer in terms of quality of life and taxes. And this is what we kind of look to educate people on. But I'm not a CPA, guys. I just implement these strategies for myself and our clients. That's where you guys need to find a CPA that will implement these strategies and work with you to, kind of change your facts to change your tax. But that's one of the big ones, right? Is, most people out there are doing 401ks, Roth IRAs, essentially just deferring taxes, which is kind of like playing checkers to some extent, where we're playing chess here. By other means, we are engineering our adjusted gross incomes down and tax bills down to what we want legally and very systematically. Another form of tax mitigation is just to list a few, conservation easements, that's kind of come under scrutiny. We've used that a little bit less. Oil and gas deals. Ooh, I mean, as there's just a lot of cowboys in that world, now you bring the whole counterparty risk involved with this. Lately, what I've been liking is if you can find deals with equipment deductions. So if people want to Google the Section 179 and kind of read up on that, essentially you're getting passive losses through there and kind of getting that and comboing that with real estate professional status, to lower your tax bill that way. But, just to list a few, right?
What about spendthrift trusts? Do you talk about those or implement those?
Yeah, I mean, a lot of these, like now you're kind of getting it more into the realm of a legal protection, right? So a lot of the stuff I was talking about was more asset protection or tax mitigation. As far as legal protection, for most people, a simple holdco LLC where they can run business expenses through would make the most sense. Up until maybe your net worth gets around $4 or $5 million net worth, or you have a high liability occupation, like a doctor where, people are suing you all the time. This is kind of where you get into this world of irrevocable trusts. That's kind of one of those falls under that category. And I do believe the spendthrift trust, I don't know if it's a intellectual property term or not. So I'm going to kind of tiptoe around using that term specifically, not to upset anybody. But what you'll find in the financial world is all these types of marketable trademark terms. I mean, we do it too. We actually have trademark accredited investor banking, which is a unique way of doing infinite banking where you don't have to do the whole 7-year, 10-year commitment. It's just like a very short 1-2 year flash fund period. And we've trademarked that. So very similar fashion, a lot of lawyers and a lot of legal promoters, what they do is they'll take a off the shelf irrevocable trust that allows you to take assets out of your name for asset protection and take that document just like intellectual property, and they license it out and sell it as cool, amazing dynasty trust XYZ, right? So this is where it's important for investors to kind of not get wooed by all these cool names and terms and kind of understand and take things for what they are and look and to systematically digest what is this, right? It's an irrevocable trust with a non-grantor component. Like that's the way of kind of looking at it. So kind of in a way, this is a square, which is a type of rectangle, right? But I think that is difficult for most investors to do, especially if you don't have a community of other accredited investors around you. And that's kind of where we tell people, well, you could sign up for coaching, but like the real benefit is having a community of other passive investors who've done the same trust that you want to get, right? And then you kind of learn the lessons learned from up here, as opposed to the legal promoter or the guy trying to sell you the $20,000 amazing trust. But again, I'm not a lawyer. We just know the people that we trust that do that for us, for our group. But we help navigate people, and generally, based on where they're at in terms of net worth, and it's kind of maybe it's similar to your guys. your brand, Alan. Like I used to work for the railroad for a long time, and it's kind of crude and conservative, that one. And we'd always say, use this term called cattle grading. In the same way, as an investor, it's what your net worth is and what your AGI is. And based on that, most people I talk to, they don't need these fancy irrevocable trusts. Just a simple holdco standard trust is fine. Certainly when you get above 8 figures, you might, spending $20,000-$30,000 for one of these fancy trusts warrants. But for most people, few grand, interacting with a legal professional with interfacing 101 is more than enough, especially when you're educated off the bat going in. I think that's the most important thing.
Yeah.
But
well, Lane, tell us a little bit about the company in terms of the Wealth Elevator, and how does that benefit our viewers and listeners, and how do they take advantage of that?
Yeah, so we started with a podcast. I started in 2016 and just kind of documented my journey. At that time, I was transitioning from single family homes to larger commercial assets. I've attracted a great community of people, a lot of engineers, some medical professionals, dentists, doctors. We have fun. I think that's the thing. We try and create this community of like-minded people going the same way, speaking the same language. To me, the way I look at the big set of curriculum that we have is it's three things. It's deals, taxes, and if in a banking, accredited investor banking, you implement these three strategies, it's a very powerful thing. But, this is a very alternative way of doing finances for sure. Most people are buying mutual funds, 401k, stuff out there. Don't get me started on 529 plans, of course, but we're doing different things than the average bear out there, and it gets lonely, and you are the 5 people you hang out with most. And that's kind of why, we've got that community support. We do events. We're actually going to be in Las Vegas this next week for our annual event. It's a good time. And if you're somebody out there who loves this financial hacking and you tell all your friends about it and none of them care, do anything about it, screw them. Just kidding. But in reality, they're never going to do anything, right? Like you will be amazed that there are people out there that are just as gung-ho as you. And when you finally surround yourself with that group, man, that you start to really grow. And this is just my story. Like I did this all by myself up until 2015. Had 11 rental properties, thought I knew a thing or two, thought I could navigate on my own. But until I interacted with other accredited investors, I didn't even know what was out there. And my network reflected that. But yeah, I'd say people like to check out podcasts, check out the Wealth Elevator, and then the book will go on sale in February. It's kind of a bigger read. I think it's like 200 pages, but it definitely goes into a lot of these smaller strategies and as you ascend the Wealth Elevator. I would say take everything with a grain of salt. You may not be there at that point yet, but I think it's good to kind of know what's kind of on that next horizon. People hike, or I always think of like I climbed Mount Fuji. I'll never do that again. That was really hard, but the way that one is, like you hike up one and then you see the next 2 purchase above, and you don't see the next 4, 5, 15, 20 something purchase above that. You only see a step or 2 above. So hopefully the book is able to allow you to have some insight, or at least just talking to a guy today, he was like, he had 6 rental properties and he kind of started to like devour our, we have a lot of free e-courses on the website. And he was like, oh my God, you saved me from buying 10 rental properties. Like, shoot, man, I made the same mistake. So, glad you didn't make that mistake like how I did.
Well, Lane, it's been wonderful having you with us again, and always wonderful to hear about your journey and your frankness and honesty in terms of your journey. Always a delight. So thanks for being with us again today, Lane. And enlightened investors, thank you for being with us. And please take a moment to like, share, and subscribe, and go to Apple Podcast and leave us a rating and review. Until next time, live abundantly, and we'll see you in the next episode.
Thanks, Alan. Appreciate for having me.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.